Welcome to Analyzing Finance with Nick. We are going to be going back into another iceberg series. In fact, I'm probably going to do 2 iceberg series over the next few months where I break down icebergs into various concepts related to finance and economics. We did the Iceberg of Finance. It was one of the original series of this channel. 2023, we did the Iceberg of Economics. And 2025, the first iceberg I'm going to be talking about, which is the one that won the poll that we did on this, is the Iceberg of Wealth Management. Just as a disclosure, I am the partner at a wealth management firm called Spearhead Advisors, and nothing in this is investment advice or any promises for better returns. I am not a tax advisor, and I'm not an estate attorney. So if you do not use this iceberg as advice about how to optimize your taxes or your estate planning needs. If you have any specific questions about anything involving wealth management, feel free to contact me directly, either via email or through the contact form in the pinned comment or the description, or through my website, nickpardini.com. And without further ado, let's get to the first layer. The first concept in the first layer is index funds. Index funds, I presume you guys are all familiar with. They're basically an investment that people can put a fixed amount of money in and buy shares of an index, usually through an ETF. The most popular index ETF is the S&P 500 ETF, ticker symbol SPY. And index funds allow investors to just not try to make specific stock picks, but instead invest in the entire index. The most common way to do this is through the S&P 500 or the NASDAQ, but could also be done with other indices such as the Russell 2000, specific sector indices. If you just want to invest in a particular sector and you think that is going to do well, but you don't know what's the best company in that sector. International indices out there for every country with a big enough stock market to really take in foreign capital has an international index. Some are tradable via ETFs, others are not. And then you have indexes for all kinds of things. But the main reason why this is the first one in wealth management, because it's become the trendy thing among wealth advisors to give up on doing specific stock picks and switch to indexing. In my opinion, I think indexing works for certain asset classes in certain times of the market cycle, but other assets, you're better off trying to actually either pick stocks or invest in active managers. I'm going to get into the active passive debate later in this iceberg, and the flaws of indexing too. But the main risk for indexing is overconcentration and the market becoming just less efficient, because indexes have gone from like 20 years ago being less than of assets under management. So it kind of brings up a freeloader problem where in theory, people don't want to have to worry about beating the market, but they can just get the market return at the index. But if everybody does that, the market becomes inefficient because there's nobody out there competing to try to beat it. And so that's kind of the dilemma with index funds. So it's a pretty simple concept. You can, for a low fee, you can buy an entire index of your choice instead of trying to pick individual securities. The next concept we're going to talk about are financial advisors. I did a whole video about financial advisors, which I'm going to put a link to in the description. But a financial advisor, there really is no true definition for it. It's kind of a amorphous term that can mean anything from a life insurance salesman to a hedge fund manager to a wealth manager to like an estate planner. It's just kind of a term that's a blanket term for anybody who helps you optimize your finances in a better way. For more details on that, I recommend watching my longer video. The next one is 401k is kind of the standard employment retirement plan, what is known as a defined contribution. There is also defined benefits, which is a classical pension where the employer funds a pension 100% and they agree to pay you a fixed amount of income every year from your retirement to your death. However, just due to the unsustainability of pensions due to demographics, the business world in starting the 80s switched from a defined benefit to a defined contribution model where instead of guaranteeing a certain amount of money in retirement, employers will guarantee that they match the contributions of their employees. So if you say you put $1,000 in your 401k, your company will do so. And they usually have a maximum limit. The most common one is about 5 to 7%. So say, for example, you have a salary of $100,000 a year the maximum you could put in with the employer matching is $6,000, and they'll put in another $6,000. So you get $12,000 and it's saved every year versus just what you would have done on your own. There are maximum limits you could put in your 401ks regardless. The next thing we're going to talk about is emergency funds are the idea that you save a certain amount of cash in case you have a financial emergency, whether it's a job loss or a medical catastrophe or some other unexpected expense pops up that you need to cover and your income is not available to cover it because it's lost or it's just way over what you normally have. And they call these emergency funds. And generally, the advice for emergency funds is anywhere from 3 months to 3 years, depending on the stability of your job and if you have plans of being an entrepreneur or what your career goals or your family expenses are. And before you generally have cash to invest in the financial markets, you should first stock up your emergency fund so that in the event that you do have a job loss or some financial emergency, you don't need to liquidate your investment portfolio. The next one we're talking about is IRAs, or individual retirement accounts, are a self-directed tax favorable retirement account, whereas a 401ks are offered by employers. An IRA is self-driven. So instead of relying on an employer to create the platform for you, you have your own IRA as a tax structure. It's usually in the form of like a specific account. Like, so if in your brokerage account, you'll have a normal taxable brokerage account, and you'll have a separate retirement account for your retirement money, which will be your IRA. There are two types of IRAs. There's a traditional IRA, and a traditional IRA is one where you put in the money pre-tax into the IRA, but then when you withdraw it, you have to pay taxes on it. But it's able to accumulate tax-free in the IRA, and you're able to contribute with pre-tax income. A Roth IRA is the reverse, where it's after-tax income you contribute to the IRA, but you can take money out of it tax-free after it compounds. Really, the decision on whether to use a traditional or a Roth IRA really depends on what tax bracket you expect to be in retirement than it is in your working years. You would rather be in a Roth IRA. And if you would rather, and if you think your income is going to be lower in retirement, then you would rather be in a traditional IRA. The other thing is with Roth IRAs, there are maximum income limit for a Roth. And the reason they do that, because they don't want high income people just putting all their money into the Roth IRA and then having less income to claim for retirement from the government's perspective. And the max in 2024 is $146,000 for a single person and $230,000 a year for married joint filers. So if you're above, you can't even fund an IRA. But there are ideas such as a backdoor Roth, which I'm not going to really getting into this iceberg, but generally that's the rules when it comes to IRAs. And the last thing in the surface level is diversification. Diversification is the idea that there's really the only free lunch in investing is diversification. The idea of putting your money in a bunch of different things is going to offer better risk-adjusted return than going all in a single asset class or a single security. And it's not, the people say, oh, I'm in the S&P 500. I am diversified. No, you're not. You're just 100% in US large cap equities. And even with that, 35% of that S&P 500 index is the top 5 biggest technology companies. And if you go to the top 10 companies, it's over 40%. So you're taking a lot of concentrated risk if you're just putting your money 100% in the S&P 500. True diversification is not just a bunch of different stocks because of correlations. You got to find asset classes that are non-correlated. So that includes bonds, that might include commodities, that might include non-US stocks, that might include stocks of different capitalizations like mid caps and small caps. That can include alternative investments or real estate. So diversification just protects you from like a specific asset class going through a out of favor down cycle or something structurally happens to impair the valuation. Whereas if you just happen to be in the one popular asset at the time, you may underperform. And it might look really bad for years and years, but over the long run, a diversified portfolio will usually catch up with a more concentrated portfolio with a lower amount of volatility and risk. Now, the next one we're going to talk about is the 4% rule. And the 4% rule is the idea is that a retiree can safely withdraw 4% of their income every year without ever running out of money, just due to investment returns and compounding. That's generally like the safe rule of what you can pull out in a given year. I personally like the idea better that your max should be a little bit under the investment yield you get that year. So you can not really tap into the principal, but you leave enough that the principal can go up with inflation and have some compounding. Because if you just take out your entire investment return every year, your principal eventually is just going to run out due to inflation. You'll need to take out bigger and bigger amounts. And that amount so unless if your investment returns are consistently higher than inflation and there's no down cycles in the market, you'll end up losing if you pull out everything. So historically, the S&P returns about 7 to 10% per year, depending on what part of the market cycle you're in. And so 4% kind of gives you a safe margin of cushion to factor in like the needed for the portfolio to catch up with inflation. The next thing I want to talk about are REITs. REITs are real estate investment trusts. A REIT is kind of like a publicly traded way to invest in a large piece of property. So say you have a large Class A apartment complex and there's really not one individual buyer who can afford to take on the whole thing. The way that investors can participate is that they split the apartment complex into shares listed on the stock exchange, and you can buy those, and that is in the form of a REIT. The real estate is owned by the REIT, and the shareholders own different shares of the REIT. There are certain rules to REITs, like they have a required payout ratios. They have to pay out 85 to 90% of their net earnings every year. You can't just retain it in the REIT. It has to be paid out in the form of dividends. And that's why REITs are generally valued not on their price earnings ratios or other classical investment metrics, but on their dividend payouts and their free cash flows or the multiple to their dividend. And also real estate REITs cannot hold cash indefinitely. Like the REITs has to be invested in real property, which is like real estate. Whether REITs, most common form of REITs are in apartment buildings, commercial real estate, such as offices and retail. And it's also data centers, farmland, and even single family home REITs exist now. So it has to be some sort of hard real estate has to be the underlying asset of the REIT. So that's simply REITs. And REITs may not have the same tax benefits as real estate, investing it in the conventional way, but what they do offer is more liquidity. So if you want to be able to get in and out of real estate and allow you to buy like big Class A type properties that are not really typically available for individuals or smaller institutional investors. And it's usually not just one piece of property in a REIT too. A lot of REITs are a whole portfolio. So say like maybe one shopping center, you're going to have a whole portfolio of shopping centers across the country. Or instead of one apartment complex, you'll have a whole bunch of either in a specific region of the US or the entire country, or even international. There's plenty of REITs that deal with overseas real estate too, if you want that kind of exposure. The next thing I'm going to talk about are 529 plans. 529 plans are basically a way that families can invest tax-free to pay for their children or grandchildren's college education. It operates similarly to like a 401k or an IRA, but IRAs are more self-directed and you can invest in what you want. 401ks are usually limited to a set of investments based on what the employer permits. And then with 529s, they're even more restricted. They're usually these prescribed 529 plans, and they're different depending on what state you live in. Each state has their own like approved 529 plan, and some of them, and a lot of this, and there's certain reasons why you would pick one state or another depending on where you live. But with 529 plans, it's usually like these prescribed limited investment options, and they're usually like target date portfolios that will target when the child that you're putting the money in is going to be ready to go to college. The advantages for this is, again, it's tax-free. The disadvantages are it's very limited on your investment selection, and the money has to be used for education costs. So if you put too much money in the 529 plans and you don't spend it on education related expenses, when you do withdraw that, you're going to pay tax and possible penalties. So that's how 529 plans work. And then the other things I'm going to talk about is active versus passive. This is one of the main debates for wealth management and investing is, do you put your clients' money into active management or passive management? Active management is when the advisor either is selecting specific investments, whether it's securities or alternatives or bonds themselves, and or hiring an active manager through a fund to do it for them. Whereas passive is that you're just putting it in a blind index and not doing anything and just staying in the index. I talked about passive and the benefits and the drawbacks of it in the index fund, but the main debate here is, should you actively manage assets or be passive? There's advantages to both. The advantages to passive is that it requires a lot less work. You have whatever the market rate of return is in a given asset class that the index is built off of. There's also, oftentimes, they might be lower fees, so it's less expensive. And then if you're an advisor, you could focus more on business development and other sides of your business because you're not really having to worry about investments because you just have a fixed passive model that will allocate to certain things and it will just take care of itself. The main disadvantages of passive is excess concentration, poorly constructed indexes. Like an example would be is like the Russell 2000. The problem I have with the Russell 2000 is that you have the best companies get promoted to the mid cap or the S&P 500, and the worst companies of the larger cap indexes get kicked in to the Russell. So as a result, there's a negative selection bias. It's like equivalent of being like the third tier league in like the English football pyramid. So you're not, whereas with the S&P, the best to the small caps move up into the S&P and the worst get kicked out. You have the opposite negative version of that affecting mid cap and small cap indices. And then there are certain other ones where like emerging market countries, the indices are heavily weighted towards inefficient state-owned enterprises, or certain countries' indices are flawed because one company is a large portion of their economy, like InBev for Belgium or Novo Nordisk for Denmark. So you have to look at the methodology of the indexes and can't just blindly assume, oh, it's a index from a major index or ETF provider. It's a great way to get the kind of exposures I want. And also just the dynamic change in the market, certain things in the index might make sense or might not make sense. And even with it, and even choosing which index to use, like say, for example, you buy the equal weighted S&P 500 versus the cap weighted S&P 500, even though it's technically choice between two passive indexes, you're technically an active investor by choosing one of those or the other. Like truly passive means you just have an all world, just very directionally or asset class agnostic outlook, which I think is not really in the best interest for most investors, especially those whose assets are large enough where diversification really makes a difference. The last two concepts are a fiduciary and a custodian. A fiduciary is really the idea that, and most registered investment advisors, such as my firm, are fiduciaries, but it's the idea that the advisor is obligated to work in the client's best interest. With a broker, they are more suitability. They just can't willingly put you in something that they know is bad for you. Whereas a fiduciary has a higher standard. They got to do what's in best interest of their clients. They can't really factor in things such as kickbacks from fund providers or to the advisor or other business interests that are not really in line with the best interest of the client. And so that puts fiduciaries at a higher standard than other advisors. And if you are looking for an advisor, I recommend picking a fiduciary so you know that their best interest, and their fee structures often reflect that. Like a fiduciary usually has a flat fee for assets under management, or maybe sometimes has for higher net worth individuals might have a performance-based compensation. But with a performance-based fee structure, the manager is willing to take excess risk because they don't get paid unless if the returns are above a certain level. And so as a result, and they get paid more the higher the returns are, but they don't really take any of the downside if the portfolio drops. So they have less incentive to be defensive on their investments and more incentive to be overly aggressive. So yeah, but fiduciary generally means that they have to be aligned in the best interest of your clients. And the last one for tier 2 is a custodian. A custodian is basically the platform that holds the assets. Like an advisor is somebody who manages the assets, whereas a custodian is the brokerage for most of the time, but it could be a bank or somebody else who takes custody and actually holds the assets. The old days would be in their vault. Nowadays, it's like a digital platform. Example would be like with my firm. My firm, Spearhead Advisors, is the fiduciary and the active investment manager, whereas Schwab is our custodian. So like Schwab is the one physically holding the assets. Like your wealth manager is not holding the assets, like in this case. Or some bigger banks, they are their own custodians. But generally, there's a custodian that is separate from the advisor. And this is generally a positive thing because it prevents things like what happened with Bernie Madoff, because there's protections built in with having a third party as a custodian. Next, with level 3, this is where it starts to get a little bit more deeper beyond the surface kind of level stuff that we talked about in the first 2 tiers. First one is a family office. And I did a video called All About Family Offices where I go into more details about this. But a family office is basically if you're independently wealthy and you have enough assets that it's cheaper for you to hire your own investment team and buy all the resources needed to operate your own in-house investment firm versus hiring an outside manager and paying them a 1% fee. But oftentimes, if you're big enough to have family office wealth, that fee goes down to like 0.5% or slightly above that. So really, the economics vary depending on how active the family directly wants to be involved in it. Like, say, for example, if you are a professional Wall Street guy and you start a family office, you may not need as big amount of assets under management because you don't need to hire a CIO or an investment team because you have those skills already. Whereas if you made your money in some non-financial related industry and you know next to nothing about finance, then you're going to probably need to hire a professional investment team to run your family office. And in order to pay them, it's going to be worthwhile to have a much larger amount of assets. So it's less than just paying the fee for a manager. So the example would be like, say if you have your entire cost of running a family office, including the salaries of all the staff and flights for due diligence and Bloomberg terminal, everything like that, is about $1 million. And if the private banker or high net worth financial advisor is charging 0.5%, then you need to have at least $200 million under management to make the family office make sense from a dollars and cents point of view. However, there's other advantages to having a family office, such as privacy. You don't have to share like the details of your assets with an outside advisor, so that might play an element in it too. And there's a status symbol. Like having a family office is like kind of like the ultimate I've made it signal. It's like I have real FU money at that point if you have a family office. That's why a lot of people in finance and the business world all strive to have a family office. So that's kind of the main advantage of a family office over like an institutional investor is that it's only usually one family, and 2, since it's a family office, they don't have to really it's just the family's direct money, investing their own money and not clients. They don't have to register with regulators because they're not a business offering financial services to other people. They're just handling their own investments. Like if you were trading your own stock portfolio on Schwab, you don't need to register yourself as an investment advisor with the regulators. It's the same with a family office, just at a much bigger scale. The next thing is FIRE, which is the abbreviation for Financial Independence Retire Early, which is the idea that if you save enough of your income and live austere enough post-retirement, you can save enough money that you can retire very early and not have to work. Like example would be like tech workers who are making, say, $300,000 a year, and they find a way to keep their living expenses down to say like $30K a year, maybe like by living with their parents or eating ramen every day or whatever. And they after tax are taking home $120,000 a year. compound that in investments, that can get up to about $1 million, and you can, at a 5% return, have 50,000, and you could live off that. So if rule of 72, that your money takes about 7 years to double, and it'd probably take you, and if you're taking home, say, like 100,000 a year, you can probably retire in about 7 to 8 years if you're willing to live a simple lifestyle. The main disadvantages of FIRE is, one, your life's probably miserable living super austere the whole way up. Two, you're not guaranteed to live long enough to enjoy that retirement. Or three, there's a real risk that either due to high inflation or down years in the financial markets, that money may not last as long as you think it does, and you might have to go back to work. And it also, the other challenge really of FIRE is it probably precludes you from having children, because the cost of having children is far more expensive than most FIRE budgets. And there are more ways that people want a more comfortable life and do FIRE, and they might take a little bit longer to save. It's called Fat FIRE subreddit as an example. But really, I think of Fat FIRE as more just conventional retirement and doing it early. Whereas I think of FIRE as more doing all the extremes you can to get out of the job market as fast as you can. And the next thing we are going to be talking about are Bogleheads. And Bogleheads are named after John Bogle, who's the founder of Vanguard. And it's the idea that people who are just dedicated to the idea of indexing, and that conventional investing is a waste of time, active manager and wealth advisors are a grift. And they just are all in on just passive due to low fees, and that nobody can really beat the market over the long period of time. And they have a lot of message boards and a very active internet community all discussing this kind of thing. The next thing we're talking about is tax loss harvesting. Tax loss harvesting is the idea that you have like investments that you can use the losers to shield some of the tax gains from your winners. So say like the capital gains tax, for example, is 15% in your bracket, and you have a stock that is up 100%, and you have another stock that is down 50%, and you invested $2,000 in both of them, and you need to sell both of them to pay for your wedding in the future. So what you can do to help mitigate your taxes is, instead of just selling them evenly, what you can do is you could sell all the loser and take the tax loss, which in this case is $1,000, and you can sell half of the winner. And so your capital gain on that half is $1,000, and that is canceled out by the capital loss from the loser, and you just keep the remainder. And so you have zero tax liability because you use the losses to offset the gains. And this is how a lot of portfolio managers help their clients become more tax efficient. So it's the end of the year and you have a generally successful year when it comes to returns across your portfolio, but either your clients have liquidity needs or you want to get out of a certain stock because you think that it's become overvalued because it's rallied so much. What you can do is you can sell the thing you want to get out of, and you could sell the biggest losers against it in order to minimize tax liability. It may not completely add up and might not have enough losses to cover all the gains of your winners that you're selling, but it will help reduce the tax burden. And also, if you do need liquidity, but there's nothing you want to sell, you can prioritize selling the losers, or at least enough of the losers and to be matched by some winners that there's no net tax liability from a capital gains perspective. There's even algorithms that do this for a lot of robo-advisors nowadays, so it's a very common practice. Next one is fees. Fees are how investment advisors get paid, or even ETFs, like indexes even have fees. And it's usually a flat annual fee on the assets under management. Different advisors have different rates of fees. Different ETFs have different levels of fees, and mutual funds too. There used to be a lot of other types of fee structures, such as loads and wrap fees and the variety of that, but those have become less popular over the years in favor of, like, for active advisors, like it's a straight fiduciary fee, active management fee. Or you have, in the case of indexes, just a flat fee on the ETF or the mutual fund. And that's generally how it is. Depending on the on the asset class and the type of advice you're getting. It's anywhere from, on the very low end, like 20 basis points for a simple index fund to 2% or more for the most exclusive hedge fund managers. Most typical advisors charge about 1%. So like in between, and most mutual funds are anywhere from 0.5% to 1.2. There are plenty of funds and advisors who are above or below those levels, but that's just kind of a ballpark. And I did a whole video about fees that I will also put in the description of this.